For years, almost everyone expected the next crash. Economists warned about bubbles, debt, inflation, and yet here we are in 2025 with the S&P 500 at all-time highs. How is this possible? What are banks and insiders not telling us? This startling mystery sets the hook. Imagine a world on the brink of disaster, banks teetering on insolvency, debt levels ballooning, yet Wall Street barely blinks. That paradox is the focus of our story. We will dive deep into history, policy, and data to uncover how we got here and why, so far, the market has defied gravity. It all started long ago. From the roaring 1920s crash to the dot-com bust of 2000 and the global financial crisis of 2008, we know how panics unfold. Excessive speculation, leverage, and a trigger then collapse. After each disaster, policymakers vowed never again. The Federal Reserve was empowered, deposit insurance created, and regulators warned of unchecked greed. Key figures emerged. Fed chairs like Alan Greenspan or Ben Bernanke, who famously said the Fed would act as a backstop to prevent panic. We'll revisit those origins and tease the twists. The same actors and policies are at play today, but with a new twist. The crash we expected has been delayed, by design or by chance. To understand the present, we must trace the roots. In 1929, U.S. stocks were wildly overheated. The Shiller cyclically adjusted P/E ratio, a long-term valuation metric, peaked around 32.5, and the market plunged soon after. The New Deal reforms that followed, FDIC, Glass-Steagall, Fed independence, were meant to prevent a repeat. Decades later, history nearly repeated itself. In 1999, the CAPE spiked to 44.2, the highest ever, and shortly after, the dot-com bubble burst. Again, regulators reacted with looser monetary policy, Fed rate cuts, which eventually sowed the seeds of the housing boom. Fast forward to 2007 to 2008. The combination of lax lending standards and complex derivatives fueled another bubble, culminating in the collapse of Lehman Brothers. This prompted an unprecedented response. Federal funds were slashed to zero. Quantitative easing bought massive amounts of treasuries and mortgage bonds, and banks received trillions in bailouts. In other words, the punch of crisis led to a counterpunch of stimulus. The origin of today's market also lies here. By the end of 2012, the Fed's balance sheet had swelled from about $800 billion pre-crisis to $2.8 trillion, and stocks had nearly tripled from their lows. Then came the most recent origin story, the COVID-19 shock of early 2020. When markets fell 34% in just a few weeks, the Fed sprang into action yet again. The Fed's balance sheet almost doubled in months, from roughly $4 trillion pre-COVID to about $8.9 trillion by March 2022. Billions in federal aid were injected into the economy. These origin events, repeated cycle and policy response, set the stage. In effect, each crash has been met by ever larger fixes, laying the groundwork for the next rise. With those origins in place, stocks began a long climb. From mid-2009 onward, the U.S. entered one of its longest bull markets. Why didn't stocks collapse under the weight of high valuations? The cause and effect story involves several factors working in tandem. Ultra-low interest rates. With Fed funds at 0%, 2009 to 2015, and even negative real rates at times, borrowing money was absurdly cheap. This led businesses and investors to leverage up. Cheap credit drove housing and corporate debt booms. In practice, as the Fed's own economist noted, when the Fed cuts rates, borrowing becomes cheaper. Some investors move money into stocks to earn more, pushing prices up. QE. Each round of QE poured liquidity into markets. Bank reserves surged, and with little else yielding return, that cash spilled over into equities and other assets. As one analysis notes, the Fed engaged in large-scale bond purchases, doubling its balance sheet by early 2022. The effect was to inflate asset prices. Remarkably, even though the Fed later raised rates by 525 basis points, 2022 to 2023, to fight inflation, investors largely expected eventual rate cuts to keep the party going. Corporate earnings and tech giants. Many companies adapted to low-rate environment and technology advances. A handful of mega-cap tech stocks, sometimes called AI stocks, drove index returns. For example, Apollo Capital's research finds the top 10 S&P 500 stocks averaged a P/E of approximately 54, roughly double the 27 of the overall index. In plain terms, a few winners, Nvidia, Tesla, Microsoft, etc., overshadowed countless strugglers. If Nvidia or Apple soared, they lifted the entire S&P 500 index by themselves. This effect is highlighted by one report. The AI bubble today is bigger than the IT bubble in the 1990s, showing the outsized valuations of top tech firms. Risk appetite and FOMO. With few alternatives to stocks, bonds yielding near zero, investors chased gains. Margin debt, borrowed money for stock buying, exploded. By late 2025, margin debt hit a record $1.21 trillion, 36% higher than a year prior. Historically, spikes in margin debt have heralded market tops. See chart below. Investors became confident that the Fed would ride to the rescue at the first sign of trouble, a phenomenon dubbed the Fed put. Government support and relief. Consider the trillions in fiscal stimulus, 2020 to 2021, and still low corporate taxes. Unemployment benefits and savings accumulated in bank accounts. All this fueled consumer spending and corporate profits. Even as many Main Street indicators lagged, Wall Street boomed on expectations that government support would continue. These factors explain why stocks rose. Easy money, optimism in a few companies, and a psychology of no fear of loss. The result? Despite rising job losses or sluggish GDP, indexes kept hitting new highs. For instance, by late 2024, the S&P 500 notched its 57th record closing high of the year, shrugging off mixed economic data. If everything was great, a crash would be unexpected, yet cracks remained. Around 2023 to 2024, analysts fretted over several fault lines, yet again, each sign was initially papered over. Sky-high valuations. We saw that the CAPE ratio in October 2025 was 39.5, near all-time peaks. The chart below illustrates how rare this is. Only the dot-com era, 1999, was higher, and every time CAPE topped approximately 30 in history, a multi-year downturn followed. High valuations alone don't cause a crash, but they indicate market complacency. When asked about the elevated CAPE, famed economist Shiller has warned that valuation is a condition, not a signal, implying it foretells low future returns, even if timing is unknown. Leverage and margin calls. As noted, margin debt hit record levels. That amplifies risk. If prices fall even modestly, leveraged investors can be forced sellers, deepening downturns. Historically, dramatic rises in margin debt coincided with market peaks in 2000 and 2007. In fact, the recent pattern is uncanny. Margin debt peaked, inflation-adjusted, in January 2025, just before the S&P's high in November 2024. In other words, investors were piling on more debt even as the market ran out of steam, a classic top-of-cycle pattern. Banking sector stress. Recall the flash crash of March 2023, when Silicon Valley Bank and two other regional banks failed in days. Depositors pulled money after bond losses and panic, echoing 2008. Although these failures were contained, the Fed backstopped deposits. Jamie Dimon, J.P. Morgan's CEO, warned, "When you see one cockroach, there are probably more lurking." Indeed, other regional banks subsequently reported troubles. Each skirmish triggered brief volatility, but no broad crash, largely because regulators and the Fed swooped in behind the scenes. Notably, Fed minutes in late 2025 reveal it quietly resumed bond buying, reserve management purchases, to keep liquidity ample. Economic signs. Ironically, some of the bullish signals were actually recession flags. By late 2025, inflation was still above target, around 3%, and the labor market was weakening, higher unemployment. History shows markets often peak just as recession hits, yet investors clung to hope. One chart of money managers' surveys in January 2025 found 60% still believed a crash was looming, but were wrong as stocks kept climbing. In short, the foundation had cracks: frothy valuations, heavy debt, and shaky banks. Yet each time the system threatened to break, some lifeline appeared. Fed promises of eventual rate cuts became a safety blanket. Central banks globally pumped liquidity, and governments signaled willingness to bail out markets again. No doubt these moves have delayed the crash, at least for now. With so many warning lights, why didn't the crash materialize? The answer lies in the remedies that kicked in, and also in a dose of sheer market momentum. Each near disaster prompted solutions, some of which paradoxically fueled the rally. Fed interventions. In every crisis after World War II, the Fed has cut rates or bought assets to stabilize markets. After 2008, it held rates near zero for a decade. Following 2020, it launched QE and stayed accommodative even as inflation spiked. In late 2024 to 25, as banks wobbled, the Fed announced an end to its quantitative tightening (QT) program and signaled future bond purchases to shore up reserves. In May 2025, the Fed even quietly bought $20 billion of Treasury bonds to aid a weak auction. These moves reassure investors that liquidity is infinite, essentially a central bank put option under the market. The cause effect is clear. Crises get met with easing, which props stocks up. Government support. Beyond central banks, governments have patched holes with fiscal spending. For example, after 2008, Congress passed the $700 billion TARP bailout. After 2020, trillions in stimulus checks and loans. Today, even as deficits top $30 trillion, federal rhetoric is to defend the economy. President Biden and Fed Chair Jerome Powell repeatedly said they would use whatever tools to prevent a financial crisis. In early 2025, legislative and executive actions, e.g. talks of infrastructure funding and healthcare reform, were clearly aimed at shoring confidence. Investors took this as a backstop. Record corporate and investor behavior. Companies themselves have also contained risk. Many have built war chests, cash reserves, and cut costs, allowing them to weather downturns longer. Businesses issued bonds at cheap rates, sometimes refinancing debt to avoid refinancing risks. Meanwhile, the explosive rise of index funds and algorithmic trading has smoothed volatility. Momentum begets momentum. When everyone expects a crash to be averted by the next Fed move, selling begets more selling from others until prices stabilize. So, paradoxically, even the fear of a crash can spur investors to buy the dip quickly, preventing a cascade. Despite these fixes, however, each cure has unintended effects. Tapping the brakes now would slow the economy, raising defaults and layoffs. Pushing another round of QE or deficits could stoke inflation or erode confidence in the dollar. The fixes are running on fumes. As the noted economist Frank McNutt warns, we're inching closer to a Minsky moment.
History
where
is
stability
rich with repeats.
breeds fragility.
Let's connect past crashes to now with some data highlights.
Valuations in history. The CAPE chart above illustrates how 2025's valuations rival the worst speculative episodes. In 1929, the CAPE was approximately 32.6, and the market soon lost nearly 90% by 1932. In 2000, it hit 44.2, with S&P falling approximately 50% over 2000 to 2002. Today's 39.5 is second only to 1999. The repeated pattern is that very high CAPE has been followed by years of flat or negative returns. Concentration and bubbles. The late 1990s dot-com run was led by a handful of tech companies. We see the same now with AI and big tech. As one chart shows, the top 4 S&P stocks alone have nearly quadrupled the forward PE of the rest of the market, suggesting a bubble in those firms. Indeed, Apollo's analysis finds the average PE of the top 10 S&P stocks is approximately 54 versus approximately 27 for the rest. That means investors are paying double for the same earnings in the index leaders, betting on continued perfection. In past bubbles, for example 1999, busting those leaders crashed the broader market. Leverage extremes. The margin debt chart below is startling. Every past spike, 1999 to 2000, 2006 to 2007, post-COVID 2021, coincided with market peaks, often preceding them by months. Now margin debt has not only recovered, it has blown past prior highs, inflation adjusted, even as stock prices stagnated. Another measure, NYSE Investor Credit, recently hit a record negative $817.8 billion, meaning investors owe more on leverage than they hold in cash. These leverage extremes mirror late 90s and pre-2008, screaming speculative frenzy. Asset bubbles and haven flows. Gold's recent surge is telling. In October 2025, gold hit a record $4,378 per ounce, its biggest weekly rise since Lehman 2008. Why would gold soar if confidence in banks and stocks were total? Because nervous money flees to safety. Oddly, a rising stock market with surging gold is a rare flashback to crisis.